When will interest rates go down? The question on everyone's mind, from home buyers and business owners to investors and economists, is when will the interest rates go down? Well, the answer isn't just a matter of curiosity. It has real-world implication for millions of people. Today, we're diving deep into this complex and crucial economic issue. Welcome back to the channel, folks. It's Dave Seymour here, and we're about to tackle one of the most pressing questions in finance and economics. When can we expect interest rates to go down? Please. Before we can predict the future, we need to understand why they're where they are right now. So let's start by breaking down what's been happening with interest rates and, more importantly, why. At the most basic level, interest rates are the cost of borrowing money. Now, when you take out a loan, whether it's a mortgage or a car loan, credit card, you're not just paying back what you borrowed, you're also paying interest, essentially a fee for the privilege of using someone else's money. But who sets these rates? While individual banks and lenders set their own specific rates, they're all influenced by a benchmark known as the federal funds rate. And this is the rate at which banks lend money to each other overnight, and it's set by the Federal Reserve, America's central bank. The Fed uses this rate as a tool to manage the economy. Now, when it wants to stimulate economic growth, it lowers the rate, making it cheaper to borrow money. When it wants to slow down the economy and combat inflation, it raises the rate. And this brings us to our current situation. Over the past 2 years, we've seen a dramatic shift in interest rates. After nearly a decade of historically low rates, the Federal Reserve began aggressively raising rates in 2021. This was in response to surging inflation, which reached levels not seen in almost 40 years. There were several reasons for this. Supply chain disruptions due to the COVID-19 pandemic, pent-up consumer demand as economics reopened, government stimulus measures that pumped money into the economy, global events like the war in Ukraine affecting energy and food prices. But why does the Fed raise rates to combat inflation? Well, it's all about supply and demand. By making borrowing more expensive, the Fed aims to slow down spending and investment, which should in turn cool the economy and reduce inflationary pressures. Now, this doesn't mean the Fed enjoys making borrowing more expensive. Their goal is to find a balance, to bring inflation under control without tipping the economy into a recession. It's a delicate dance with major implications for all of us. So, with that context in mind, let's address the big question: when will interest rates go down? The short answer is, it's complicated. The honest answer is, no one knows for sure. Even the world's top economists and the Federal Reserve itself can't predict the future with certainty. However, to predict future interest rate movements, we need to consider several key factors: inflation trends, economic growth, labor market conditions, global economic factors, Federal Reserve policy. So let's take a look at each of these. Inflation trends. Inflation is perhaps the most crucial factor in determining the future path of interest rates. The Federal Reserve has set a target inflation rate of 2% over the long term. When inflation is significantly above this target, as it has been recently, the Fed is likely to keep interest rates higher. The good news is that inflation has moderated since its peak in 2022 of around 9%. However, it's still above the Fed's 2% target. The key question is, how quickly will inflation continue to fall? Some economists argue that much of the recent inflation was due to temporary factors like supply chain disruptions and pent-up demand following the COVID-19 pandemic. If they're right, inflation could fall more quickly, potentially allowing for earlier interest rate cuts. Others worry that inflation could be more persistent, particularly in areas like wages and housing costs. If this view proves correct, well, we might be in for a longer period of higher interest rates. Economic growth. The pace of economic growth is another crucial factor. The Fed aims to achieve a soft landing, slowing the economy enough to bring down inflation, but not so much that it causes a recession. Recent data has shown the US economy remains resilient despite higher interest rates. GDP growth has continued and consumer spending has remained strong. This resilience might actually delay interest rate cuts, as the Fed may feel less pressure to stimulate the economy. However, if we do start to see signs of a significant economic slowdown, that could prompt the Fed to consider lowering rates to support growth. Labor market conditions. The Fed also closely monitors the job market. A strong job market can contribute to inflation, particularly through wage growth. So far, the US job market has remained robust with unemployment near historic lows. This strength gives the Fed more leeway to keep rates higher for longer. However, if we do start to see a significant uptick in unemployment or a slowdown in wage growth, that could put pressure on the Fed to lower rates. Global economic factors. While the Fed focuses primarily on domestic economic conditions, global factors can also play a role. Economic slowdowns in major economies like China or Europe could impact US growth and inflation, potentially influencing the Fed's interest rate decisions. Similarly, geopolitical events that affect global trade or energy prices could shift the inflation outlook. Federal Reserve policy. Finally, we need to consider the Fed's own policy stance and communications. The Fed provides regular updates on its economic projections and policy intentions. In recent communications, Fed officials have emphasized their commitment to bringing inflation down to their 2% target. They've indicated that they expect to keep rates higher for longer to ensure inflation is truly under control. However, the Fed also stresses that it is data dependent, meaning it will adjust its policy based on incoming economic information. This leaves the door open for earlier rate cuts if inflation falls more quickly than expected or if the economy shows signs of significant weakening. So after considering all these factors, what can we say about when interest rates might go down? While it's impossible to predict with certainty, we can make some educated guesses based on current conditions and historical patterns. Many economists and market participants are currently expecting the Fed to begin lowering rates sometime in 2024. This view is based on projections that inflation will continue to moderate and that the cumulative effects of the rate hikes we've already seen will start to slow economic growth. However, it's important to note that these are just projections. At the time of this recording, the Fed is actually meeting today, and the signaling is that we will see a 25 bip or a quarter point reduction forecasted today, but we shall see. The actual timing will depend on how economic data unfolds. If inflation proves more stubborn than expected, or if the economy continues to show strong growth, rate cuts could be delayed into 2025 or beyond. On the other hand, if economic growth sharply slows or inflation drops faster than expected, rate cuts could potentially occur earlier in 2024. It's also worth noting that when rate cuts do begin, they're likely to be gradual. The Fed typically moves in small increments, often 0.25%, unless faced with severe economic downturn. So what does this mean for you, for me? If you're considering a major financial decision that's sensitive to interest rates, like buying a home or refinancing a loan, it's important to consider your personal circumstances rather than trying to time the market. While rates are higher now than they were a couple of years ago, they're still not extreme by historical standards. If a home purchase or other investment makes sense for your personal financial situation, waiting for rates to drop might not be the best strategy, especially when considering that asset prices, likely home prices, often rise when interest rates fall. Higher rates can provide opportunities for savers and investors, and high-yield savings accounts and certificates of deposit are offering their best rates in years. But keep in mind that when these rates eventually do fall, these yields will likely decrease as well. The path of interest rates is never certain. It depends on a complex interplay of economic factors, many of which are difficult to predict. While we can make educated guesses based on current trends and historical patterns, it's always important to be prepared for different scenarios. We can confidently say that the Fed will continue to monitor economic data closely and adjust its policy as needed to support its dual mandate of price stability and maximum employment. As the economic landscape evolves, so too will the outlook for interest rates. But I would love to hear from you. How are you currently affected by interest rates in your life and in your financial decisions? What's your prediction for when rates will start to come down? Leave a comment below and let us know your thoughts. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more insights on economics and personal finance. And don't forget to hit that notification bell so you never miss an upload. Until next time, keep watching those economic indicators, and remember, in finance, knowledge is power.